You're listening to the REI Clarity Podcast, the show that guides you from confusion to clarity and sets you on the path to financial freedom faster. Learn how to grow your portfolio the right way with your host, REI advisor and co-founder of Shine Insurance, Jeremy Goodrich.
Hey there, Jeremy Goodrich, your host for the REI Clarity Podcast. And as I've said with previous guests, I'm really excited for the interview that you're about to hear with our guest today. Not only do you get to hear from an investment property owner who has taken the leap from part-time investing to full-time investing and making money off of real estate for his family and building a nest egg and wealth, but he's got such a great story of how he grew. He'll tell a little bit of the early part of his story, and then he'll dig into his relationship with service providers and some of the things he's done, not only as an investment property owner, but also as a property manager himself, to make sure that his service providers are following through with the promises they make. We all have had interactions with contractors. We have all had interactions with property managers where we thought something was going to happen and then it just didn't happen the way it was supposed to. Our guest today is going to give you some insight on how to handle that and how to make sure that every service provider interaction is as good as it can be and they follow through with the things that they say they're going to do. After that, he digs into his first multifamily buy. And for those of you that are sitting with 2 or 3 single family rentals and wanting to take that next leap into multifamily, I think it'll be a fascinating story to hear how he went from having a couple single family rentals to getting that first multifamily. That's the majority of the show. But when we get to the end, it kind of jumps really quickly into where he is now. Our guest, in a very short period of time, has grown his portfolio exponentially, and he shares with you how he went from that first multifamily buy to the place he's at now. So I couldn't be more excited to introduce our guest in the interview that we had. Jennings Smith is going to share with you some real insights that you can take and turn into action as soon as you're done listening to this show. So glad you joined us, and I hope you enjoy the interview. So tell us a little bit about how you got started in the real estate world and what attracted you to it.
Sure. I have to give a lot of credit to my dad. He always was involved in real estate. He was a real estate agent, but he wasn't building a ton of long-term wealth. And I think he was in his mid to late 40s. He said, "Hey, I've got to change something here." And so he started buying rental homes. He bought a defunct subdivision and started hiring builders to build him rental homes. He even hired me to build him a few rental homes as I got my builder's license. Those were some of the first homes I built, and they weren't great. They didn't have to be, but
You got to start somewhere, right?
exactly, yes. So I built a 1,300 square foot, 3-bedroom, 2-bath home about 5 times for him. So
You watched him grow from a real estate agent into something that built him a little bit more wealth, right?
absolutely, he had a little bit of money. I think he borrowed the money to buy the defunct subdivision, which had 20 lots. It was like something crazy, like $12,000 in the depths of the depression there in 2007-8. Then sold off a few lots to get himself the money back, and then he leveraged that to build his first rental home, and then he just kind of kept rolling the equity and going one house at a time. And he didn't ever do it with partners. And so he eventually, though, has about 15 homes completely paid off and has built himself a pretty stable retirement income. And he's still a realtor. He's still, making income off of that. But it really showed me the path to wealth. And he explained to me what he was doing and the leverage of it. And just to show how when you buy a house and you put down 20%, let's say you buy a $100,000 house, $20,000 in cash, but it goes up 2% in value, which would be 102,000. It's like you just made 10% on your $20,000, even though it only went up 2%.
Yeah.
But he also warned me it's a good way to get there, but once you get there, the returns are not great. And then he showed me, like, once the house is paid off and you're paying the mortgage and the taxes and the insurance and the vacancy and the repairs, it's like you're really only making 5 to 8% return on your money.
So he felt like the buy and hold had value early on, but maybe not as much value as it got deeper into the relationship with it?
Exactly. Once you get completely unleveraged, you're tying up $100,000 maybe, to rent a house for eight or $900. It doesn't make sense. And it's happened to me. I bought a house 4 or 5 years ago, put 25 grand down, $100,000, and now it's worth 175. I think I owe like 70 on it, and I can only rent it for 13 or $1,400 a month, and it's only cash flowing like two or $300, and I'm
Yeah.
tying up $100,000 in cash. And yes, I'm making money on the mortgage pay down, and the appreciation, but it's just that neighborhood has gotten too expensive, and I need to dump that asset and put it into something a little bit more leveraged.
So how do you usually pivot those funds? Like if you're going to make a move on that particular property, what would be the perfect turnaround on it?
So the perfect turnaround, I believe, is trying to sell it to your tenant. So we put the tenant in a credit repair program, and we're working with her because, I mean, they're already there. They're paying you rent while they're working on fixing up their credit. They're going to pay pretty much whatever you say within reason that it appraises for. They're not going to negotiate too hard with you. Yeah, and then you close and the house is, and you don't have to do any repairs or maintenance, or I mean, it's like that. I think is the best as far as like transactional costs to you, is
Huh.
to sell it to your tenant if you can.
And then do you tend to seller finance that, or how do you navigate that side of it?
So I do have some deals that I have seller finance. This deal I'm not, just because it's such an, well, I say expensive. I mean, 175,000 is not too expensive, but I've sold like mobile homes or little 30, $40,000 houses, seller financed. This I'm just helping her get a conventional loan on.
That's cool. So then, as far as your strategy in general, what would you say when you look at your portfolio as a whole, your strategy or strategies are?
So I followed in my dad's footsteps and got, first I started with some mobile homes, bought them for 5 grand, put 5 grand in them because I could remodel them myself, and then I would sell it for 20,000 seller finance so that I didn't have to do repairs.
Hmm.
I did that a couple times successfully. I'd sell it on a good interest rate, make them put a few thousand down, and I had one person out of seven default on that. Had to take it back and remodel it again, and that was disheartening to see a beautiful thing that I had done get just demolished in 3 months. but but that's part of it. If you're going to get in this world, like, you got to be able to take the lumps. But as I grew the portfolio and got into a couple single family homes, then I started managing everything poorly because I was trying to manage like 5 or 6 properties myself and also run a full time construction company and family and wife. And, I wasn't doing inspections, and I started to lose money. And then I decided, okay, I'm going to put this stuff with property management. And I hired a property management firm, and they turned it around and they made it a lot easier. And I saw, okay, this is more scalable. I can add more because everything I add doesn't create a huge burden onto me. And I see that as a mistake that a lot of newbies make, where they want to make the deal work. They're trying to make the deal work. They're like, well, I can manage it myself, so I can save that $100 a month or whatever it is. And that is really just foolish, I think, because yes, it's going to work for one or two or three houses, and you can manage it yourself, but you're setting yourself up to be a mule, and you want to be a magician. This world is something that you can leverage your efforts, and if you're sitting there calling plumbers and running out and not doing the stuff very well, it's going to bite you. So I think that was a mistake I made, and I would encourage, it's like, if the deal doesn't work without property management, then find a better deal.
That's interesting because I think so many people feel like bootstrapping, or house hacking or whatever, they're going to kind of go in there and take care of it themselves. And maybe you can. And certainly people succeed at that all the time. But the side, what you just described is like sometimes you forget that you probably don't do it as well as a good property manager, that you may not do the inspections, that you may not have the tightest contracts, that you may not have a lot of the things that make your properties profitable on your own. It's like any good business owner realizes at some point that if they want a good logo or a good design for their website, that if they do it themselves, they might save some money, but they're going to spend a ton of time, and it really isn't going to end up being what they thought it was. And this, application is the same when it comes to real estate, that if you think you can do it yourself, that may be true for some period of time, but you've got to remember that there's if you keep doing it as you grow bigger, then there may be things falling through the cracks that you don't even realize because there's no checks and balances on your systems and your processes.
Absolutely. And you're not you're not going to do it as well as someone that's like eat, sleep, living property management and really cares about it and is passionate about it. And there are a lot of property management companies out there that aren't that good. Actually, most of them aren't that good. And that's why there's a bad rap about them, but there are good people out there, and if you find them, that's going to make your life a lot easier, and you're going to get higher rents because you're going to let it sit for a couple years and you're going to be like, he's a good guy, I don't want to raise rent on him, and that's fine, but your taxes are going up too, and your maintenance is going up, that AC unit is running out, that roof is running out. Like you've got to think beyond just, well, I'm making a few $100s a month, so it's fine.
That's so good. Like, as far as that, not that it takes the heart out of it, because I think there is one of the key parts of real estate investing is not only making money. Obviously, that's a key part of it and the heart of it, but also that we're providing these living spaces for folks, and we're actually, taking care of our tenants in a real fulfilling way. And sometimes that can become, well, I don't want to raise rent, or start to feel in a way that maybe isn't the healthiest for your bottom line. And a nice balance is obviously good, and having a good property manager can do that. You mentioned a lot of bad property managers and some good ones. Can you describe a little bit for our audience? Are there certain things you can do to find those good ones?
Yes, yes, absolutely. Property management is a really difficult business. It's thankless. There's a lot of liability, and there can be conflict. And a lot of people don't like to deal with conflict or won't deal with conflict. But there are individuals that relish it. That really are good at it, and they're not afraid to take a hard line with tenants, but also know when they need to be flexible. I think that the biggest thing is calling their references, other owners that work with them, and are
Mhm.
they doing what they say they're doing? Because every property management company will say, we're going to be inspecting your house every 3 months or 6 months, or we're going to be changing your filters, and we're going to be vetting these tenants, and we're going to be running credit checks, and we're going to be taking big deposits, and we're going to be protecting your asset. I mean, they all have the same spiel, and I have a property management company, so I say the spiel too. But I guess it's just trust but verify. Like, are they actually walking your property every 6 months? And something we do that's cool is we do a 30-day inspection. So we place a new tenant. 30 days later, we're walking that property, so that if we screwed up, like if we placed like somebody that lies and has, three Doberman pinchers in there and is tearing it up, then we know it right away and we can get that person out before they cause $10,000 worth of damage. And a lot of companies, they'll put somebody in there and then they'll never ever go in there again. It's unreal, but a lot of management companies, they say they're doing it. And so what I would do as a property owner is create a Google Drive file or box or whatever you want to use, and force your property management company to live up to what they're promising they're going to do. So if they're going to go buy your house every 6 months, they got to drop photos in there every 6 months and put it in your calendar every 6 months. Check in with property management and just shoot them an email, and they will be like, "Oh crap, we didn't do that," and they'll go and they'll inspect it, and that's going to eliminate a ton of your problems. It's just putting in the right tenants and then inspecting the property.
Yeah, and holding your property managers to the agreement they made at the beginning, right? So they said, I'm going to do these things, and hopefully they will, and you'll learn to trust your property manager over the course of time, because you'll get a true sense of whether they are actually doing it. But I think what you just suggested, Jennings, is awesome, just to have some system in place where you're checking in on that for certainly the first couple years you're working together, and probably over the course of your entire relationship, not because you don't trust them over time, but because you just want to make sure that you're getting that energy from them, and that connection from them. It brought a couple of things in my head. One, I was a school teacher for 13 years, and one of the school teacher sayings is, "Don't smile till Christmas." Like, come into the school year and be very serious and regimented, and what you're doing there, not that you truly have to do that, but what you're doing is setting a system, saying to a group of people, hey, this is how it works here, and it's gonna work this way, and so that everybody gets comfortable with that, and then you can back off a little bit, because everybody understands the expectation of the group. And I don't remember what the second thing was, but that was the analogy that came to my mind on how to navigate property managers.
Absolutely. And they will make or break your property.
So property managers are a key part of your property. And I think I heard something from you that I haven't heard in the past, which was really an argument for property managers, even with a smaller portfolio. Do you have a sense of where that line is? I mean, is it even at one, or when is a time that you might consider switching to a property manager if you're not using one?
Yeah, I mean, I don't want to be dogmatic. You obviously can manage one or two properties on your own, but I would draw that line at one because it's setting you up for begin as you mean to go. You want to build a big portfolio. You want to have hundreds of units, hopefully, or maybe even thousands. And you're not going to be managing thousands of units or hundreds of units. So if you want to have hundreds of units, then why are you setting up systems and processes that are going to break and not work? They're just going to slow you down, and they're going to enslave you to this job that you've created. And you didn't do this to get another job. You did this to create financial freedom.
Yeah, I love it. Just building that system and strategy and treating yourself as a business owner, which I think some investment property owners struggle to do because it doesn't feel quite like a normal standard, whatever mom and pop shop, but it really is. And I think the better you can set those systems up and strategies, obviously the better you do.
And that's why I made the leap into multifamily eventually, or as quickly as I could, because it's just a lot easier to scale. It's a lot easier to have those systems. The numbers make sense, and it's just more of a business. And every apartment complex you buy is its own standalone business that can have an accountant, a property manager, a maintenance guy, and P&L, and generates money and pays mortgages off, and just it can exponentially supercharge that goal versus one at a time. And that's kind of where I went on my next evolution after I got a couple rental homes. I mean, it took me 4 or 5 years just to get 7 properties. And I thought, okay, this is cool. I'm somewhat proud of myself that I did this, but this is so slow. Like I'm not going to get to 1,000 doors. I had set in my mind, I want to have 1,000 doors by the time I'm 50 or whatever. And I just could not see getting there with single family.
So talk about that transition a little bit. So what was your first multifamily buy and how did that feel?
So I was working full time. I had a construction company, Alair Homes, which is a franchise. So I had my own company. I converted to an Alair Homes franchise because they had more business processes and systems, and I felt they could help me exit that business. And so I was doing that full time. I was also the regional partner for Alair Homes. So I had multiple franchisees under me, and I was very busy. But I bought Michael Blank's course. I don't know if you ever heard of that, the Ultimate Apartment Buying Guide. And it was $1,000. I think it's $2,000 now. And it was really eye opening. They have deal analyzing spreadsheets. It walked you through like how to find deals, how to talk to brokers, how to syndicate, the legal structures, how to talk to investors, how to raise money, due diligence, all that stuff. It was cool. I mean, it was great. But I studied it for like 2 years because I was so busy and I could not pull the trigger on this thing.
Hey, it's Jeremy putting my ad hat on right now. As you know, my primary connection with the investment property world, my zone of genius, is investment property insurance. I am the REI insurance guy. Our team at Shine Insurance takes care of investors from all walks and all strategies. If you need insurance for your portfolio, and of course you do, I'm offering a free one-on-one call just for REI Clarity listeners. On that call, we'll chat through your scenario and I'll share insights and thoughts on how to get your insurance right and whether Shine is a good fit for you. No pressure, no slimy sales, anything. Just me on the phone sharing my insights. To book that call, go to shineinsurance.com/REI Clarity. That's shineinsurance.com/REI Clarity. So you had the idea in mind. You knew you needed to evolve from the single family up to the multifamily, particularly if you were going to get as many doors as you wanted to have. And so you spent a couple of years studying not only, the system of how to do it. Were you looking for properties the whole time?
Oh yeah, I was always looking, and I actually was close on a property. It was about 4 hours away, a 40 unit, but it was pretty. It needed a really big renovation, and I even sold my house. Like I sold my house, liquidated all the capital in my house so that I could buy an apartment complex. Like I was committed to this goal.
Did you do that early? Did you do that early on in your process? Like, did you have to hold on to the funds or however you had it set up because you didn't have a buy?
Yeah, like I did it. I took the course, and I and there were other factors in selling the house that it allowed me to convince my wife to do this. But
That's a serious commitment.
but yeah, I sold it and I had the money. And then some things went a little squirrely with my business, and I didn't feel confident plunking my entire life savings into an apartment. And so I was living in a rental, eating through my income. My business was not doing very well, and it was really depressing period of my
Huh.
life. But
Yeah. So was the course giving you hope at that point? Like you were working through it, you knew you could do it. It was just like a matter of
yeah,
when it happens? Yeah.
yes, and every few weeks, I would jump on LoopNet or Crexy or these MLS sites and just try to find something, and just kinda I was halfway doing it, but the course gave me the confidence to say, "Okay, well, maybe I can do this with someone else's money. Maybe I can." I'm in an unstable position right now, like, I'd like to keep my money in the bank, but
Mhm.
there are other people that have tons of money, but they don't know how to do what I know how to do now, and maybe I can partner with them. And so that's what I did. I found a deal in North Carolina, so it was 5 hours away, so it was not, like, right in my backyard, but it was 12 units for $240,000. It was insane. It was a good deal, but it was losing money. The owner had a bunch of apartments, and this was just, like, out in the middle of nowhere. He didn't wasn't paying attention to it, and it wasn't doing well. So I went to him, and I knew I didn't have much bankability at that point. So I said, "Hey, listen, your property's losing money. Like, I probably can't finance this. Will you finance it for me?" He's like, "Yeah, I'll seller finance it. You put down 30%," which was pretty hefty, but I said, "Okay."
That's a commitment so the seller knows that you're in,
Right, exactly. So 20, 240 times 3 is whatever, 72 or $3,000. Plus I needed another 20,000 just for like carrying costs and in case I need to repair anything. So I raised $93,000. So I created like a little sheet. I brought it to the investor, and full disclosure, the investor was my dad.
That can either help the relationship or hurt the relationship. I think it depends, but yeah.
Well, and that's the thing. My dad, he likes me. Obviously, he wants to see me succeed, but he's also savvy, and he's not stupid. Like he's not just going to give me $90,000. So I showed him. I was like, "Look, Dad, you got these rental homes. You're not doing that well with them anymore. They're all paid off. Here's a deal that we can do this. We can refinance it in 2 years. I can fix the if I just do a rubs with the water, like a utility bill back with the water, and I raise rents a little bit. We'll be able to refinance it, and I'll pay you. I'll split it with you 60-40. I get 60%, you get 40. He's like, well, why don't I get 60%? I'm bringing all the money. And but that was a really like a crossroads where I could have said, okay, well, yeah, you're right, whatever. But I said, no, I have the deal. I was like, this is a good deal, and there's plenty of people with money. If you don't want to do it, then you don't want to do it. And he's like, no, no, I want to do it. I want to do it. And he came around, and
You
so
worked your first deal. I mean, not your first deal, but your first big deal.
right, exactly.
Yeah.
And even if I had, given up more equity, that would have been fine too. Because get your first deal done. I think that's so huge to just get a deal done, like a deal that's not going to hurt you.
Yeah. So that was your first deal. So did it work out? Like what's been the outcome of that particular property?
It's worked out well. I've owned it. I bought that in like April of 2019, so I've owned it for a little over a year now. I've gotten the rents up. I've gotten everybody on the utility system, and I'm actually in the process now of like digging a well and putting a well in because the water in that area, for some reason, they charge you out the nose for it,
Mhm.
and so
Yeah.
we're gonna put a well in. But yeah, the it's making money. I got a manager up there. I interviewed a couple managers, and one was a disaster. Just like fly by the seat of your pants manager, and I could see right through it. And then,
Yeah.
but I found this, older lady that was a realtor and had a great reputation, called some references, and everyone seemed to be happy with her. And she's done a great job. And yeah, so we took rents from, I want to say rents were like at 415, and we've gotten them to about 500. So we've gotten a $75 increase, and no one's left. So pretty good. We did have a slight flood where the first floor flooded, and we had to replace the flooring. But we had the money. We had we had 20,000 in capex, and that was important to overcapitalize your deal a little bit to have a buffer. And now we've paid quarterly distributions 4 times, so my dad's making money, I'm making some money, and a straight up syndication like that is nice for somebody starting out because you can get paid quickly versus like a preferred return. You're a little more nervous about having to stack cash to pay that preferred return to your investor.
That's cool. So that the multifamily example there in what you just laid out is really, I think, what so many listeners are kind of imagining doing. It's that step. Maybe you've got 3 or 4 properties, single family rentals, and you want to take that step up into multifamily. So what were the top 3 things from, and let's, I guess, just focus on that deal because we have the story right in front of us, but the top 3 things that you took away from that as this is how we do deals.
I would say the first piece is knowing your underwriting, like knowing that you have a good deal on your hands and stressing that underwriting and having multiple options in case things don't go as well as you think they're going to go.
What do you mean by multiple options? Like multiple property options or multiple financing options or?
Multiple exits where it's like if you're buying a property that is not cash flowing, then you've got an issue. If you're buying a property that's cash flowing already, like it can cover the debt service and the expenses, maybe it's not making much money, but it's still breaking even. That's a lot safer position than buying something on the hopes, oh, we'll be able to raise rents $100, no problem. We won't have to do anything. We're not going to have to do any renovations. And then you try to raise rents, the market responds to you, and there's crickets, and you realize, oh, well, I didn't do my rent survey. I didn't really test the market. I really didn't know what this market would bear. I didn't interview property managers to see if we could get $500 for a 1 bedroom in this town of 5,000 people, which is a very small market. There was some risk associated with that deal, but I did my research on it, and I thought that it would work, and it did. However, if it hadn't worked, I still would have been okay with the rent basis as it was. Like I still would have been able to break even. Like I wouldn't have made any money or my dad any money, but we wouldn't have lost the building. It would have just had to kind of struggle along for a few years until we could exit, but it wouldn't have been catastrophic.
Okay, so number 1 on that one was know your underwriting, do your research, use your pro forma or whatever documents you use, understand the risk you're taking by picking up this property. What's number 2?
And I would say a quick way to do that is when you're looking at your cost per door
Mm-hmm.
and your rent. Like you've heard of the 1% rule, where if you buy $100,000 house and you can rent it for $1,000 a month, that's probably a decent deal. Well, in multifamily, you want to be at least at 1.5 if you can. And so if you can buy it for $50,000 a door and you can rent it for $750 a door or a month, you're probably going to be pretty good. And that multiple is 1.5. Well, we were buying it for 20,000 a door and we were renting it for $500 a door. So we're getting over a 2 multiple. So that gave me a lot of confidence if I could get my value plan. And if I couldn't, they were still renting it for $400 a door. So there was still meat on the bone there.
Yeah. So again, back to knowing what you have, and if you can buy with 2, you've got 2% there. I mean, then you have room to move. If you end up at 1.5, well, you're still inside of what you feel is a good place to be.
Exactly.
And that's all about getting started and knowing, doing your research. All right, in that deal, like what else? Looking back on it, it was a learning experience or something that you're like, hey, this is what we should do.
I think always starting the deal off with gas in the tank, over capitalizing. I mentioned that where it's like, oh well, we only need 72,000 to close, and then we're gonna have 5,000 in closing costs. So really, I only need 78,000, and I'm nervous enough about asking money, so I don't want to ask for any more than I need, and that is not the way to go. Because we're doing a bigger deal right now, and we started off the project with the 150,000 in carrying costs, and it saved our behind that we had all that money. And even in this little project, having $20,000 in the bank, when that flood happened, it wasn't catastrophic. It was like, okay, we planned for this. We knew something was going to go wrong. Either the roof was going to go bad, or we're going to need to replace the carpet, or somebody was going to move out and we're going to have to renovate a couple units. Like, we were ready for this. So I would say always, always, always over raise. Like, figure out what you need for your down payment, figure out what you need for your closing costs, and then have a little bit in the tank. And in this case, we had about 10% left. And that depends on the size of the project. If you're buying a $5 million building, you might not need 500 grand, but you need probably 150, 200 grand.
Yeah. And do you feel like when you're going out to investors, and your dad was the example in that one, but when you're pitching to investors, are investors comfortable with that overcapitalizing pitch, or do they push back against it?
He did push back a little bit on it. Like I said, he's tough. But
Yeah.
but I told him my reasoning that, hey, we need a pressure wash. We might need a new roof. Something's going to go wrong, and I don't want to have to come back to you and ask for more money. And it may not be a good time to ask you for more money. And a capital call to your investors is never a confidence-inducing thing. If you have to do it, you have to do it, but you don't want to do that.
So again, it's about, being clear up front, even, whether it's knowing what you're purchasing in the property, whether it's overcapitalizing when you're finding your investors. Both of those things are really like clarity up front, and making sure you understand the property, you understand what's needed, and that you're making safe moves, essentially.
The flip side of that is, like, we have another project, a mobile home park, where we overcapitalized. It was about the same size project. We overcapitalized by about 20,000, and the park was doing so well that, I mean, we had like 35,000 sitting in there, and we just really didn't need all that money. And so we made an extra distribution to the investor. It was a single investor, and she's thrilled. I mean, she's like, "Oh wow, I got."
They're going to be super happy.
Yeah,
Yeah.
that's like, dude, I want to invest with this guy again. I want to tell everybody I know, hey, I found a guy that's generating 15 to 20% returns, and he knows what he's doing. Like, that's how you start to raise capital for bigger deals.
It's sort of the under promise, over deliver type of vibe. Like, make sure the promises you're making when you're looking for investors are reasonable, and worst case scenario are exactly what you said, and best case scenario, you're handing them back money quicker or more than they thought they were going to get.
Exactly, and you're under promising on the underwriting too.
So then, what do you think? I said three things and we did two. So what do you think the third thing that you learned from that deal, or that investors should think about from these multifamily deals?
I think that it's really important to think about your exit, like researching the bank that's going to take you out, or get your investor their capital back. So the way we structure deals is we promise, well, I wouldn't say promise, but it's like the deal is structured where we're going to get them the money back in 18 to 24 months if our plan goes well. What we have to know is, like, what is that refinance going to look like? Like, how is the banker going to underwrite us? What cap rate is he going to use? What leverage are we going to be able to get in that market? And how much value do I have to add to this building? If I bought it for 250, it's got to be worth 375 or 400 to be able to get that money back out and my investors cash back out. What bank not what bank are you going to use, but how is that bank going to view that? And familiarizing yourself with the world of finance. I think people are afraid of that, but the more comfortable and confident you get with understanding how commercial bankers think and work, the more you'll be able to dominate this field and make good decisions.
Do you reach out to that commercial lender even when you're going into the deal, and just ask them what their thoughts are? I mean, obviously no one can predict 2 years down the road or a year down the road, but do you engage with your commercial lender on these thoughts of exit while you're figuring them out, or you kind of have a sense
Yes,
already?
absolutely. Every single time. Like, before we even place an offer, we're saying, hey, we thought we could get a 6.75 cap rate on exit. We thought you would give us 75% leverage. What do you
Mhm.
think? Well, these are our average rents. What kind of expense ratio would you underwrite that at? So those three questions I asked: what's the cap rate? What's the leverage you're going to give us? And what expense ratio are you going to be using? Because if I'm underwriting at a 40% expense ratio and the banker's underwriting at a 48% expense ratio, our valuation of that building is going to be hundreds of thousands of dollars different.
Totally different. Yeah.
And that
Yeah.
matters when you're telling investors, hey, we can get you your money back out, and you can't. But you also, there's some risk too. Like, COVID-19 could happen, and leverages across the board drop 5 to 10%. There's nothing we can do about that except for kick the can down the road another 6 months and see what happens. But we're still paying our investors 10% preferred return and cash flows, and I mean, they're not mad, but you still want to do what you say you're going to do,
Yeah.
if at all possible. And so if you don't know what you're talking about, you're going to look really foolish when you go to try and refinance that building.
That makes total sense. I love exit being the third one and being prepared for that right from the beginning. So those were a ton of great insights on really the leap to multifamily. I mean, I think that was sort of a primer on the things you need to think about in that buy. There's obviously lots more, Jennings, but those three pieces make a lot of sense to me. Is there anything else on that multifamily topic that we just totally missed?
I think just getting started, understanding how it can build on itself, where I did a 12 unit, you can then jump to an 18 unit. I jumped to a 63 unit, to a 40 something unit, to 190 properties in a year. Now we've got a 200 property or 200 unit under contract, got a 593 unit under contract. I mean, that's a $40 million deal. I mean, less than a year and a half ago, I was buying my first 12 unit. You can get confidence with this stuff. You can get scale with this stuff if you're willing to educate, learn, put in the work. But the rewards are there. And I just don't feel like the risk reward in the single family is so difficult. I mean, it's possible that you can build 1,000 unit portfolio in 5 years in multifamily. Very possible. Actually, not even that hard. Whereas single family, that's almost impossible to do.
So what is it that helped you to scale so quickly? Like what changed? Because we talked a lot in this conversation about the early part, and then you scale quickly from 2018 to now. Like what was able to trigger that?
Paying for education and paying for mentors and partnering with heavy hitters.
What are some examples of, like, not the person, but of the roles of the heavy hitters that you were able to connect with and get this going?
I mean, the first thing I paid for Michael Blank's course.
Uh-huh.
That was a fairly cheap course, but I learned a ton. I would recommend that to every listener. It's a good building block basic of course. Then
Mm.
I went to Tim Brott's event, Commercial Empire. It was, I think it's like $5,000 or $7,000. I don't know. So it was a little bit bigger investment. I went there with my partner, who I own the management company with. So we split the cost, and that, I mean, blew open my mind as to what I could do with this stuff. When I came back from that conference, I was so excited, and then you get hit in the face. I mean, because it's like, okay, well, how am I going to find these deals? And it's
Like when you
crazy.
come home from every conference or every motivational, yeah, now you get how to do it, and now it's like doing it, but which is a hit in the face type of thing.
But we did. We got an 18 unit, and that was too small for Tim, because Tim's thing is he'll partner with you if you find a deal that he likes, but he has very strict criteria. And so we found this deal. It didn't work for him because it was very small, but it did work with another person that I had met at the conference. Then he came down, looked at that property, and he looked at the other 63 unit that we were looking at, which was like 5 million. And Tim Brotz's criteria is like 100 units or more. And so this one didn't work for Tim either. But he said, hey, I'll do that deal with you. And he has significant net worth. He had significant experience with commercial finance, a lot more than I did. Very sharp guy. So that forged a partnership. And now we pretty much do everything together. So all those bigger deals that I described, he's in them on me. And his partner, I mean, they have a huge portfolio, and they kind of mentored us. And just connecting more in the multifamily sphere, you figure out who the players are, who are the people that are doing stuff, you connect with them and trade
Yeah.
deals back and forth. And so it was really mentoring, connecting, and getting in the room with people that they can collapse time, where you don't have to learn everything yourself. You can partner with somebody that has already been there, and they can bring you forward 10 times faster.
Yeah, I love that so much. The relationships are such a huge and key part of it. Well, I'm excited for you and that growth in such a short time. What's your favorite part of what you're doing? Like what makes you the most happy?
Honestly, it's it's the thrill of the hunt. It's like finding these deals, analyzing them, and being like, okay, that's a good deal. We got a live one. Because we sort through so many that are just junk. They're not a deal, or the seller wants way too much. But when you find one, you're like, we can make this one work. And then putting that thing under contract. And then the next challenge is going through the due diligence, making sure everything looks good. Then you've got something beautiful you packaged up that now you can pitch to investors. And now investors are saying, yes, we believe in your dream. We think this is great too. We're going to make money in it too. We'll give you, here's $100,000 share. Well, I mean, when you raise $1 million, like I was looking at a bank account. It was my bank account. I mean, for the business, it had $1.3 million in it. It's like, I've never seen that much money in my life. And I raised that. And people trusted us enough to do that. Yeah. It was incredible. And you close it and you have teammates in your property management and your contractors to execute your value add play or whatever you're doing. But the thrill and the challenge of finding deals, putting them under contract and raising the capital for it, that's my favorite part.
I love that. Any last bits of advice for folks listening and are just inspired by the work that you're doing?
Yeah, I would say get started. And it could be just, hey, I need to sharpen the axe. Like I don't know what I'm doing. I can't add any value, so I need to learn. I need to learn about this, or I need to plug into this world. And I think that's important to do to gain a little bit of confidence. But I also see a lot of people sitting there too, where they're just going to conference after conference and reading book after book and Googling and learning. And like I did, I didn't need to study Michael Blank for 2 years. Like that was my own fear that was holding me back, or lack of action, or whatever belief that I had to do this all with my own money. I would say, yeah, sharpen the axe, learn if you don't know much, but you probably do. And if you do, you need to start just moving the needle, talking to investors, talking to brokers, uncovering a deal. Because if you find a good deal, the money will appear. Trust me, It will.
So it's like, yeah, let the education be the foundation, but start getting the experience, because education can only take you so far, and experience is going to jump in at some point. And the more you have of it, the better you're going to do.
Exactly. Like Dan Pena says that he can sum up every self-help and motivational book in 4 words, which is like, just effing do it. It's like, go out there and do it, stop reading about it and just go take action. And I think a lot of people, they get paralyzed. I've been paralyzed where I don't want to make that phone call. I don't want to cold call. I don't want to put myself out to the investor. I'm afraid of rejection. And you've got to let your goals be bigger than your need to be liked or your need to be cool or popular. Like, you got to tell people what you're doing and put yourself out there, and you might fail. And that's, you got to be okay with that.
Yeah. Learning is safe. And sitting and learning things is safe, but going out and doing is less safe inherently, but it's the only way to actually achieve the goals that you're looking for.
Absolutely.
Well, Jennings, thank you for being willing to just come and spend a little bit of time chatting here. It sounds like your journey is really just getting going, although at the point you're at now, it may not feel that way. But I guess I was doing the out, but I mean, are you still planning to get to 1,000 units by 50?
No, I'm planning to get to 1,000 units this year. So that's my goal. Now, I won't own all those 100%. I've got partners in all those, but no, I've revised the goal.
That's awesome. I'm so glad to hear that, and so inspiring. If folks want to check in with you, find you in any way, how can they do so?
You can shoot me an email, Jennings@rentliveoak.com. Jennings@rentliveoak. I'm on Facebook. Live Oak Investments is our business page. We put out a lot of content there. And we actually have a free download available on how we got a 175 unit self-storage with no money down, and we're getting 60,000 back at closing. So I'm pretty psyched about that deal. And we have a download that we just break it down, scripts, how to, everything there. But yeah, just shoot me an email, hit me up on Facebook, Jennings Smith, and be happy to connect with you.
And we'll put a link in the show notes to that download if you want to get it from Jennings. So check that out as well. Jennings, again, thank you so much for being on REI Clarity.
Yes, sir. Thank you. I appreciate it.
Special thanks to Jennings Smith for taking the time to share so many great insights with us today. Wow, exponential growth from 0 properties or very few properties to over 1,000 doors in less than a couple of years. What an amazing growth strategy you all just heard. If you enjoyed this podcast, I wonder if you can think of who needs to hear this, who is about to make their first multifamily buy, or maybe has just been stuck in the space of educating themselves for years, just trying to know, trying to understand and needs to take that leap, please share this episode with them so that they can take that leap. When you're done with that, if you haven't done so already, please leave a 5-star review for the show and go ahead and share some information about what you liked. I really appreciate those 5-star reviews, but man, the descriptions, when you really talk about what it is you liked about the show, is so much more valuable because we can learn and we can grow from it. If you haven't already joined our Facebook group, that's a great place to grow community, one of the key parts of our framework, and we're there to help you do it. All right, until the next time, here's to clarity that builds financial freedom faster.